concern on this, that how to bring this law, in what form and shape. In principle, a lot of people agree that we should have this kind of a law, but in what form and substance is something which is a matter of debate. This is the anti-avoidance law. So what is this anti-avoidance law which is being talked about, and why it is so important, and why it is can be so draconian to all of us? Let's look at that. So before you read the details, what it seeks to do is that if there is any transaction, the primary purpose of which is avoidance of tax. Okay? Primary purpose, or one of the primary purpose is to avoid tax. Then tax officer can disregard that transaction and give its own character to that transaction. Not only this, but the tax law says that taxpayer has to prove that this is not a transaction to avoid tax. So it's guilty unless proved otherwise. So let's look at what is it that is there in this law. So they say that if there is no commercial substance behind any transaction, then that can be treated as an impermissible transaction, and tax officer can give its own color to it. So, few examples of that which are there in this are, say, if you have a company which has 1 lakh of share capital, okay, and say 90 lakhs of loan from the shareholder, okay, so all the profits can be given to the shareholder as interest, and that interest will be allowed as a deduction against the tax profits, because there is no express thin capitalization rule in our law. Now this GAR can effectively read thin capitalization into our law. So it can recharacterize that debt into equity and consider the interest as dividend. This is only one of the examples. But there can be several examples of reclassification of a transaction, which may look appropriate on the face of it. Legally, you would have entered into transaction. Law-wise, it is perfectly valid. But if you don't find the commercial substance behind that transaction, then tax officer can recharacterize this and levy tax on that. But what is the process which has been given in the law to invoke such a rule? So assessing officer will make reference to commissioner. Commissioner will call the taxpayer if he feels that there is a fit transaction to invoke her, and he will ask for explanation from the taxpayer, and then he will refer to a panel, and once the panel hears out and give it back and say, yeah, it's a fit case to invoke a GAR, then it will be sent back and the adjustment will be made. And by this order of GAR itself is an appealable order to the tribunal. So you will have another proceeding of facing GAR as a separate proceeding by itself. The question is how fairly this law will be implemented at the commissioner level, whether it will be only a approval, routine approval to be taken and it will be invoked routinely, or there will be substance scrutiny and given a fair chance to the taxpayer to demonstrate his case. On the transfer pricing provisions, now this is a good provision. Lot of places we need some kind of an alternative dispute resolution process, because our own dispute resolution process is very slow. It takes a lot of time to resolve any matter. Transfer pricing is one of such areas where the law is still evolving and you don't have definitive precedents to be applied to. So APA or advanced pricing agreements is a methodology which is used in the developed jurisdictions, whereby the taxpayer enters into an agreement with the government saying that I am entering into this kind of a transaction with my related party and this is the price that I want to apply to. If you have any objection to it, let me know right now, so that I don't fall into any trouble later on and would be into courts on disputing this price. So this mechanism has been introduced whereby in advance only there is a determination or an agreement between the government and the taxpayer that this is the price that is going to be acceptable to the tax authorities in a transfer pricing situation. This transaction or this agreement will be valid for 5 years unless the revenue officer comes back and say that there are some facts which were not disclosed or there was a misrepresentation of facts. Then in that situation this agreement will stand void. It's a good step and let's see how effectively it is implemented. Which has taken place and it is going to impact a lot of us, but it is going to take a lot of disputes also. What it says is that the transfer pricing provisions which were applicable only in a cross-border situation in a related party transaction, these would now also apply to domestic transactions. So domestic related party transactions, the DP provisions will apply. One. Second, if there is a tax holiday being claimed by any unit and that unit is having a transaction with a related party, either with the other units of the same company or with a related company, those also need to be justified by a transfer pricing documentation. A very important change, but a helpful change. This 5% plus minus 5% safe harbor was available in case of a transfer pricing range. So there are several changes on that. You would be aware that this 5% plus minus ran into several disputes. First one was whether this is a standard deduction which is applicable in all the situations as a matter of routine, or it is to be applied only in a specific positions. So they have clarified that this is not a standard deduction. They have retrospectively done it. That's one. Again, one of the disputes closed in the favor of revenue, not in the favor of taxpayer. Last year, what they did was that they took away this 5% at all. They said 5% is not necessary everywhere. So government has taken power to notify the range from their side, that they will come up with what is the safe harbor. So till now they have not come up with anything, but they have come up with a law further on that, saying that whatever we will come up, it cannot be more than 3%. So they have further made sure that that leeway will less than 5%, it will be only up to 3%. So more and more you will see that they are tightening the transfer pricing regime in their favor. On the immovable property, and this will affect probably everyone sitting in this room at some or the other point. If you want to buy an immovable property from anyone, okay, Now you pay that price and buy it. So what is the change which has come? What this law seeks to do is that you will have to withhold tax of 1% from the purchase price and deposit with the government. And this is for individual also. This is not restricted to corporates. So if you are going to buy a own property, whatever price you are going to pay, if it's more than 20 lakhs in other cities and more than 50 lakhs in some of the identified urban areas, Chandigarh is not there as urban area there, Delhi is there, Gurgaon is there, then 1% of the price you will have to deduct tax at source and deposit with the government, but neither the payer will have to take a tax deduction account number, nor you will be required to issue a withholding tax certificate, nor you will be required to file a statement or return with the tax authority. So they have made easy for the payer, but certainly all other provisions of non-deduction, penalty and all will be applicable to you. So which means that if you buy the property, then be ready and do not forget this compliance which is going to come on this. With by this one provision, now government is gone directly reached to the parties transacting the transaction. And it will certainly, they know the pulse that people would be fairly nervous in a direct interaction with the tax authorities, and they will declare the transaction value which is the real transaction. They are aware that what happens in a property transaction. Yes,
this is the
of course.
widening the ways.
Yes.
Let it be afterwards, we will take the decision, but let's widen the ways.
That's right. Yes, and this will start from 1st October. Now, an interesting situation will arise that if you would have already made the complete payment prior to 30th September, but if you go to the registrar after 1st October and ask him to register, then he will say, show me the TDS. You said, I have made the payment. I don't know. The law says that 1st October onwards, I can't register anything without this TDS certificate. Then what will happen? So that is not there in this. And I hope that while in the law this position is clear that you can't do something which is impossible, but the registrar will not understand there.
Why this 6 months window has been provided? Why?
No, because what happens is that the passage of the bill takes time. So this kind of a procedural provisions, generally they come impact after some time.
But June or July generally they
I appreciate that there is a June or July by that time, but probably they want some people to be mentally prepared around this, and this will probably take a lot of awareness to be created. This kind of a provision, since every individual can be involved. So they would have kept some time in order to make this provision known to a lot of people.
let it sink in.
That's right.
So if you were to buy a property from a land or something, what would be the scenario then?
I think there is no exemption for even a developer property. Yeah.
So the primary purpose is widening the tax base. Is there any secondary purpose of this that can come into picture?
Secondary purpose is advance collection of tax.
Okay. And wouldn't it affect the price of the property?
I don't think that the price has, the only thing is that if people were not factoring the tax cost earlier in the transaction, they would now probably factor in this cost in their deal. But that is one-to-one deal. That will not impact the price of the property. I don't think so.
I guess it will just be priced in. So when the seller quotes his price, he knows that 1% will go to the next class, so will just bump up the price. So at the end,
Registration.
That's right.
Seller doesn't have a PAN number, so how will the person pay the tax?
Yes, so that detail is yet to come on what kind of challan they will prescribe, whether their PAN will be made as an important precondition
Individuals to be
in their challan or not? At least they have exempted the payer from obtaining that.
Yeah.
Like very flat.
This stamp duty value you are referring to is the same as circle rate or something?
Yes, sir. Circle rate. Software in case of a cross-border transaction. If you acquire a software from a non-resident, then there is an issue whether this software payment is considered as a royalty or a business income. If it is royalty, then it attracts TDS. If it's a business income, it does not attract tax in the hands of the non-resident seller. So this issue was live. There were several conflicting precedents on this. Latest one being Karnataka High Court in the favor of revenue and Bombay High Court in case of Bombay Tribunal in case of taxpayer. They have resolved this. They were sitting on it for last 12, 10 to 15 years. They did not do anything on it. Now they have clarified this retrospectively from 1962 in favor of revenue, saying that it is royalty. Not only that, they lost Asia-Sat case, whereby Asia-Sat, the satellite receipts were not considered as royalty by Delhi High Court. So revenue lost that case. They have changed it. They said it is considered as royalty. So if you have to clarify a law, at least clarify at the point when it is first going for a dispute, not when it has been resolved finally in favor of the taxpayer somewhere very close to Supreme Court, or at Supreme Court level you see something changing, then you change it in favor of taxpayer, the revenue.
What does the law say? I mean, the general law as per the constitution. Can they do something like this?
So there are, two, and that's also a point of law. As to, the point is that a substantive levy of tax cannot be done by way of a retrospective charge, but a clarification can be done by way of a retrospective charge. So the question is whether this is a clarification in the law or substantive levy is a point of law which will be coming up for if someone challenges the constitutional validity of this amendment to be retrospective. And Vodafone also, someone will certainly challenge that. This
It's a matter of 12,500 crores.
Correct.
So suddenly they are going to fight.
If it is 12,500 crore for India, then it is 12,500 crore for Vodafone also.
And
No,
look
sir,
at
it
the
is
other
a
200
natural justice. We are not giving any opportunity to person to define himself.
Right. And it's like sitting in the parliament and doing, a lot of things to the favor of the revenue.
India is already at somewhere ranking of 180 in the world ranking of
Confidence.
business.
Yeah. And Supreme Court said in Vodafone case that you have to have a stable tax regime and a certainty of a tax policy. If you want us to rule something, then have your tax law like that.
But I think we have seen earlier 90s, but we have the tax inspector also there. Until if you see the 90s Rajat Committee report, they were taking all the discretionary power from the assessing authorities to give a fair there should not be corruption or discrimination. Now we bringing all the same power to bring at the revenue, but you are bringing again the same law there, which you have been in this, which you all reform bill.
Right. Another example that they can't tolerate the tax going out of their hands. So minimum alternate tax, last year you saw that it got extended to LLPs. This year they have said MAT will be levied on all kind of businesses, on all the ownership structures. MAT will be levied if they are claiming those special tax holidays.
Previously it was with the private limited companies and companies, not on the partnership firms.
That's right.
Now,
Last year, it was extended in case of SEZ or ATIC or ATIA or 10A units to LLPs.
that's
This
right.
year, they have extended to individuals,
Oh my God.
partnerships, HUL, trusts, everyone. Okay, first one. If there is an Indian company, suppose they want to issue share at premium, okay, and the market and the valuation mechanism is giving that premium, say of 100 rupees base par value, the premium is coming to 50 rupees, so 150 is the total price and 50 is the premium. But if they receive from the shareholder say 175, then earlier this 175 was considered an extra premium and this extra 25 was considered an extra premium and not taxable. They said anything over and above a justified premium will be taxed in the hand of the recipient as income. So in our example of 175, whereby 50 was the premium, 100 was the par value, but if company receives 175, then 25 will be considered as income in the hands of issuing company.
Sorry, I have a quick point, actually for Mr. Chawla and Upama, who are, I believe, are representing TAI as well. I think this will have a major impact on the financing of startups, because all the angel investment that's coming in right at the start, when the value is zero of the